Hello, everyone. I'm Philipp, chair of the OBBBA Taxation Law Section. The tax section is sponsored by Hochmann Zorc and Toscher Press. The Hochmann Zorc and Toscher Press PC advantages experience in hyper innovation and a genuine dedication to clients, their families, and their business. In addition to their national practice in civil and criminal tax controversies and related litigation in federal and state courts, the firm is also active and successful in handling other non-tax white-collar investigation and prosecutions. I'm delighted to introduce our speakers, Najjar Sharif and Angela Jill. Najjar is an AUSA at the United States Attorney's Office, Tax and Bankruptcy Section in downtown Los Angeles. Ms. Sharif has 20 years of litigation experience representing the interests of the United States on behalf of the IRS in bankruptcy and civil tax matters in federal and state court, handling some of the biggest and most complex tax cases filed in the Central District of California. Prior to working as an AUSA, Ms. Sharif was a tax attorney with the IRS Office of Chief Counsel in Washington, D.C. and in Los Angeles, California, where she tried numerous cases in the United States tax court involving complex novel, and high-profile tax issues. With her collective experience in the U.S. Attorney's Office and the IRS Office of Chief Counsel, Ms. Sharif has developed an expertise in tax controversy and bankruptcy tax litigation matters, including in refund litigation, tax deficiency litigation, the assessment and collection of tax, federal tax liens and levies, summons enforcement, FBAR cases, surplus fund cases, foreclosure actions, and complaint in depleted actions. Angela Jill has been practicing bankruptcy law for over 16 years. Ms. Jill is certified by the State Bar of California as a specialist in bankruptcy law. She worked as a staff attorney for a Chapter 13 trustee in the Central District of California, Los Angeles Division for 10 years. She also served as an AUSA for the U.S. Attorney's Office in Los Angeles for 5 years, primarily representing the IRS and bankruptcy court. Since 2025, Ms. Jill has returned to the private sector representing debtors and creditors in bankruptcy court. Najjar, Angela, take it away.
Okay, thank you. So if we could start the slide presentation. Welcome, everyone. Good afternoon. Welcome to Don't Get Left Behind, Navigating Bankruptcy and Tax Trends in 2026 and What to Watch For. Thank you very much to the Beverly Hills Bar Association and our co-sponsors, the litigation section and the business law section of the California Lawyers Association. My name is Najjar Sharif, and Angela Gill and myself, we are very excited to have a discussion with you this afternoon. Questions, we'll try to answer the questions at the end of our session. If we can go to slide number 3. Yes. So before we start a discussion, I think it's important to very briefly go over some of the topics that we are covering. Today, we are covering bankruptcy filing trends, what is driving the increase in bankruptcy cases, and of course, the One Big Beautiful Bill Act. What's happening at the IRS? Student loans, everybody's favorite topic, and our final thoughts. Angela and I are going to be doing this in a discussion style, or as I like to call it, podcast style. So let's go and begin the discussion. If we can go to slide. So we're going to start with the national trends in bankruptcy filings. So what is going on in bankruptcy filings? Next slide, please. So after many years of the post-pandemic uncertainty, bankruptcy filings are actually climbing steadily. This is a graph that I was able to get from the Administrative Office of the United States Court. Hopefully, your materials will have a better, you'll have a better idea with the actual numbers, but we did try to provide the graph because it's important for our discussions. So at the end of 2025, last year, bankruptcy filings totaled about 574,314, which was the total amount of bankruptcy filings nationwide. compared to 2024 when the bankruptcy filings were around 517,308. So there was an 11% increase in bankruptcy filings from 2024 to 2025. Now, that number actually, if you look at the chart on your left side, bankruptcy filings in 2020 from 2023 to 2024 actually increased 14%. So 2025, it actually decreased a little. And then from 2023 to 2024, the number actually increased 16%, right? So while it's gradually increasing from the 2021 number, right? And the 2022 numbers, 2022, I think, was particularly low in the last 5 years at 387,721. Generally, bankruptcies are steady, rising, and going in the upward direction. So what about the business bankruptcy filings, right? We have the chart there. In 2025, there was a 7.1% increase going from about 23,000 to 24,000. The non-business filings, of course, that rose 11.2%. And in 2025, we had a total of about 549,577. Now, just as a point of reference, does that number sound like a high number to you? Well, let me take you to September 2010. In September 2010, the total bankruptcy filings were 1.6 million. Yes, that's right. It's not that you didn't hear me correctly. It was 1.6 million. So compared to that number, 549,000 is a lot less. The lowest in the last 10 years or so was 2022, which had filings of 380,000. So we're steadily increasing. Now, with respect to the bankruptcy filing, how does it compare when you compare it to the Chapter 7s, the Chapter 11s, and the Chapter 13s? Well, if you look at the right side of your screen, there is a graph, and based on that graph, most of the filings appear to be in the Chapter 7 arena, right? So just even in 2025, the Chapter 7 filings were 356,000 and change, Chapter 13, 207,000, and of course the Chapter 11s, less than 10,000, about 9,200. So you could see that, anywhere between 60 to 69% are the Chapter 7s. We have anywhere between like 25 to 35% the Chapter 13s, and the 1 to 2% are our Chapter 11s. Now, the Chapter 7s obviously dominate the bankruptcy filings nationwide, and the numbers continue to steadily increase because the consumer lack of disposable income and the mounting financial strain. There's also, which Angela will talk about, some of the factors like inflation and interest rates, and of course, the resumption of the federal student loan payments. Now, if we can go to our next slide. This slide is actually an interesting slide. This slide actually, it's a snapshot of the business bankruptcy filings, and particularly the small business bankruptcy filings. In the third quarter of 2025, business bankruptcy filings hit around 24,000. This number actually is the highest quarterly total since 2016. While some of this 24,000, reflect activity from larger firms restructuring through Chapter 11, a growing share involves smaller, younger businesses taking advantage of subchapter 5. And what do I mean by smaller, younger? I'm talking about less than 5 employees, young, less than 10 years in operation, and earnings of less than 1 million. So that's the type of small businesses that I'm talking about. And so what does this mean, right? With respect to the businesses and what bankruptcy options they have. Of course, Chapter 7, liquidation, right? It's the most straightforward and final form of bankruptcy. Businesses cease operations. Court-appointed trustee sells off the assets to repay the creditors. Chapter 11, this allows a business to continue to operate while restructuring its debt under court supervision. And of course, there's Chapter 13, primarily for individuals, but sometimes used for sole proprietorships, right? So, and sole proprietorships, the businesses are considered the same. Chapter 13 bankruptcies and individuals use the personal and the business part because it is a sole proprietorship as the same entity. Now, what we are seeing in terms of trends is that more and more these younger, small businesses are filing for bankruptcy, and they're taking more and more of the large chunk of the business bankruptcy filings. And this chart shows you what percentages of the small businesses are filing for Chapter 7, for Chapter 11. So the Chapter 7 are the blue graph, part of the graphs. The Chapter 13 are the black. And of course, you have the Chapter, wait, let me make sure that I'm not giving you the wrong colors, because this, okay, so Chapter 13 actually are the purple, and Chapter 11 are the black. So you can see how small businesses are taking advantage and filing for bankruptcy through either Chapter 7, 11, and 13. Now, what does this mean? Well, what this means is that these groups are now representing the majority of business bankruptcies, showing that financially fragile entities are highest among the newest and smallest businesses that are entering in the market that are less than 10 years in the business. While subchapter 5 is helping many small businesses stay afloat, many are by making reorganizations. Many of these small businesses are looking to Chapter 7 and Chapter 13 to get that fresh start. Angela is going to talk now about, so what I've been talking to you about are the national bankruptcy filing trends. And Angela is going to take us to our district, the Central District of California. Next slide, please.
All right, thanks, Naja. So I just wanted to give you an update. This is not part of our slides, but just as of today, actually, a report from Yahoo Finance on national bankruptcy trends. They just published a report based on the first quarter of 2026, and the trend continues. As you mentioned, subchapter 5, Chapter 11 cases have increased by 67%. Of the total. The total increase, according to this Yahoo Finance report for the first quarter, is about 14%, so a little bit higher than the 11% that we saw, year over year for 2025 that you just discussed. So the trend is continuing upward, and that's also what we see in the Central District, our district, which is the largest district in the country. We are, according to the current stats, we are experiencing a 20% growth in filings from last year. That's just through 2026. And then, as you can see on the chart here, this data is a little bit older, but it shows a general trajectory upward. And as Naja mentioned, 2022 was the lowest level of filings over the last 10-year period, and that nationally, and that holds true for the Central District as well. And we attribute that, can't say for certain, but we attribute that lower level of filings in 2022 due to a lot of pandemic era relief programs, not only with moratoriums on certain, collection activity, including rents and mortgage payments, but a lot of government benefits in the form of, cash inflow, to businesses and individuals alike in the form of, COVID relief programs, payment protection programs, disaster relief programs, a pause on student loans, which we'll, discuss later. This all really enabled consumers and businesses alike to kind of stay afloat. And once those programs started ending or ended, we saw, the rise in filings begin again in 2023. So I think, you can see the chart here. These charts are actually for 2024, and the information. Can we go to the next slide, please? I think the next slide may have. Yeah, the next slide breaks it down by chapters and even adversary proceedings as well. Subchapter 5 in particular is used by smaller businesses generally, and the levels of filings in subchapter 5 continue to rise. That's a quite popular election by smaller businesses or people who are over the debt limit for chapter 13. Still find subchapter 5 to be a little bit more manageable. So that contributes to the popularity and higher numbers in subchapter 5. Can we go to the next slide, please? And this slide, okay, yeah, we can skip. That last slide was also our district levels of self-represented litigants, pro se filers as we call them. But let's move on to the next slide here, or this slide. So in general, economists and bankruptcy professionals, this is not an exact science when we try to nail down what are the causes and what are the driving forces behind the increase in filings, but there are definitely a few factors that I think people can agree, professionals and economists and people who study this type of thing, which are driving some of the recent trends and increases. As Naja mentioned before, that September 2010 level of filings, which are over 1 million, that was in the, right in the amidst the Great Recession. So that was a historic levels of filing, which thankfully we have not reached, those levels. And I don't think anyone expects to reach those types of levels in the near future, hopefully not. But there is an uptick and a general trend that we see going upward. And that has to do with post-pandemic kind of factors in the economy, including the high cost of borrowing for consumers and businesses alike. Higher interest rates have made it not only harder to borrow money and refinance, but also leads to higher levels of defaults. We have ongoing inflation, even though it's not as high as it was even in 2023. The effects of the persistent inflation and cost of goods is affecting businesses and consumers alike. The tariff concern, the directs of the tariffs are not quite, effects of the tariffs are not as direct. We can't see them directly, but they certainly play a role in business planning, uncertainty, and of course, supply chain disruptions caused by all these factors combined. So we'll discuss a little bit of that in more detail. If we can move on to the next slide. So when we talk about interest rates, one thing that's interesting to note is that the current prime rate is 6.75%, which doesn't sound crazy because it was as high as 8.5% in July of 2023. But if you compare it to pandemic era levels where the prime rates were as low as 3.25%. So if you're a business, especially if you're a small business, and a lot of small businesses, depend on variable rate loans for their equipment, for their supplies, for a variety of things that are, tied directly to this prime rate. So that can make a huge difference in the cash flow and just, the viability of small businesses, which already have been experiencing, smaller profit margins for, a variety of other issues. The interest rates can make it increasingly difficult to stay current on debt servicing but also to refinance to get out of those types of loans or to get better rates has been increasingly difficult. And we find that not just for businesses, but for individuals as well. We hear about this in the mortgage and housing arena, where mortgage rates are, stuck in the 6s and 7s, like even, and making it very difficult for new buyers to get into the market, and for existing buyers who encounter trouble or fall behind. It's really difficult to refinance, even with high levels of equity in some homes. So in general, that's causing problems for people. And as another thing that we've seen is foreclosure rates on real estate have increased by 20% in the last year. So that is definitely another driver of bankruptcy filings, especially in the Chapter 13 arena for individuals who are defaulting on their home loans. Okay, can we go to the next slide? Okay, we did want to have I am by no means an expert in this arena, but I did want to touch a little bit on the ongoing discussion of tariffs, the global supply chains, and the most recent U.S. Supreme Court ruling that just came down, which outlawed the last round of tariffs under the IEEPA. So if you haven't been, following it that closely, the U.S. Supreme Court said that the president did not have the power under the International Emergency Economic Powers Act to impose as broad tariffs that were in place. And as of February 20th, 2026, those tariffs were essentially overruled or undone. But then the administration went ahead and so I have a note here that before the IEEPA tariffs were struck down, they had risen to an effective rate of 16%, which is really, if you think about it, that's the highest it's been since the 1930s. I mean, it's really a drastic effect on, especially on American and American suppliers that depend, or American businesses that depend on supplies that are subject to these tariffs. After the U.S. Supreme Court ruling in February 2026, those tariffs effectively went down, so that now their effective rate is about 13.7%. Or they went down to 9%, excuse me. And then the administration changed the tariff structure again under Section 122 of the Trade Act of 1974. So the administration used a different tool to impose a different set of tariffs, so now the effective rate is significantly less at 9%. But what overall, the reason I wanted to discuss this, and we did attach the actual opinion, the U.S. Supreme Court opinion, which is pretty lengthy, but if anybody really wants to study it in detail, it's there for you to read. What this effectively does is cause a lot of uncertainty for businesses in their planning and in their own budgets, because it's so up and down and constantly changing. That certainly is having an effect on businesses, although it's hard to measure the direct effect on bankruptcy filings. I did want to mention that because it is a current topic. So we can move on to the next slide. And then we have tax changes. Nadja and I both will be discussing parts of the One Big Beautiful Bill Act. So this is Public Law 119-21, which went into effect last year on July 4th, on 2025. You may have heard about some of the features of this act, but it's really, it really is far-reaching, and it really, creates a lot of changes, or in the tax code. So some of the things I want to highlight are things that affect consumers directly, which, may or may not, depending on the circumstances, can be helpful or not. But these are a few things that are, consumers before they become debtors in bankruptcy are, grappling with. There are some positive changes for individuals, including the increased standard deductions, which are projected by most tax professionals to allow people to have a higher tax savings, individuals that is. Those amounts have are stable. They're at $15,750 for individuals and $31,500 for joint filers. These amounts were actually increased with the Tax Cuts and Jobs Act back in 2017, and now they are with the One Big Beautiful Bill Act makes that change permanent, and then they're adjusted on a yearly basis. Another big change that's going to be effective with this year's tax return filings under the One Big Beautiful Bill Act are what we call the SALT deductions, the state and local tax deductions. For states with high income and property taxes, like the classic examples are New York, New Jersey, and California, back in 2017 with the Tax Cuts and Jobs Act, property tax and certain local tax deductions were capped at $10,000, whereas now that limit is going to be increased to $40,000. So that is also going to expected to bring a big tax savings to individual taxpayers, especially homeowners in states like New York, New Jersey, California, where we have high property taxes and high local taxes. Having said that, from a bankruptcy perspective, I think bankruptcy practitioners, especially those that represent debtors, should really be aware of this and be looking carefully at tax returns. And, unless there's some emergency situation which is causing people to file before filing their tax returns, I would keep this as a practical point in mind to file those tax returns. And if you're expecting a refund, file those before you file your bankruptcy so they're not subject to being turned over immediately to the bankruptcy trustee, to the extent you can plan around that. So that's just a little practice pointer, I would say, if you're a debtors counsel. And then there's a few other things that have been talked about in the news that we just thought we'd mention as part of this One Big Beautiful Bill Act. The elimination of federal taxes on tips, cash tips, or tips charged on credit cards is temporary. It only lasts till 2028, but that may help some, restaurant workers and hospitality industry workers a little bit. And then we have these Trump accounts, which are these savings accounts essentially that are going to be started by the federal government for a certain amount of time. We'll see if it's extended for children, babies born January 1st, 2025 to December 31st, 2028. But those are just a few of the common kind of newsworthy things that the One Big Beautiful Bill Act that you may have heard about. But the next, if we can go to the next slide, the thing that makes a big impact in bankruptcy is the effect of the One Big Beautiful Bill Act on the employee retention credit. So Nadja and I, we can both just talk about this a little bit, but if you're a creditor's attorney, you may or may not have come across this. If you're a debtor's attorney representing businesses, you probably have come across this in some way, shape, or form. But the employee retention credit was a really popular credit created during the pandemic to allow businesses to claim certain essentially credits on their taxes for keeping employees on payroll even while their businesses were otherwise shuttered or limited because of the pandemic. And it was another one of these programs designed by the government to help businesses kind of stay afloat during this unprecedented pandemic time. Subsequently, and Naja, I'll let you talk about this a little bit more. Unfortunately, there were a lot of problems. I don't want to go so far as to say fraud, but the government did find a lot of problems in this program and the applications for these credits, and certain promoters that were, kind of reaching out and soliciting a lot of business to apply for these credits, not in the most correct way, for lack of a better term. But for those people who did who were using the program appropriately, it did provide a lot of relief, and the credits were extremely helpful. And in the bankruptcy scenario, I saw during my time at the U.S. Attorney's Office on behalf of the IRS, we saw quite a few of these claims come in, usually in the form of an objection to a proof of claim filed by the IRS, where the debtor entities would, claim that, hey, my tax bill should be reduced because I'm entitled to this credit. And then from the debtor side, also, assisting debtors in getting these claims processed, which takes a long time. There was a moratorium placed on processing these claims for, I believe it was at least 18 months, if not longer. I don't remember the exact dates. But finally, the government did start, processing these applications for these credits again. However, in the meantime, under the One Big Beautiful Bill Act, there are now limitations again. Not just limitations, there's a flat out bar in that the IRS is prohibited from processing claims for the third quarter of 2021 or the fourth quarter of 2021 if those claims were filed after January 31st, 2024. So that does limit, for a lot of smaller businesses, they did not become aware of this program and or know that they could apply for these credits until, after those quarters. And so while it seems like a big gap in time between 2021 and 2024, a lot of companies and taxpayers who thought they qualified for this credit did apply during that time, and now they will be prohibited from getting that credit, and the IRS is actually prohibited from even processing it, even if they were otherwise eligible. So keep that in mind if you're a debtors practitioner and you have a client that's expecting this claim or has a claim in process. You might just double check that the quarters that they've applied for, which ones can they realistically expect to get a response on. Naja, do you want to talk about some of these other parts of the employee retention credit program?
Right. So thanks, Angela. So while the law generally does not require the immediate clawback of refunds already issued before July 4th, 2025, the IRS has significantly expanded its enforcement capabilities, and the statute of limitations for auditing 2021 claims has been extended to 6 years. Now, pending claims filed after the deadline are automatically denied, with affected taxpayers, receiving. Now, amended returns, however, the restrictions don't apply to amended returns filed after the January 31, 2024 deadline, if the sole purpose was to withdraw a previously filed claim. So you just have to keep these things in mind when you are working with your, with the debtors that may or may not have these ERC issues. So if your claim was filed after January 31, 2024, but was refunded or credited before July 4th, 2025, then Section 706005 does not apply to your claim. However, other IRS compliance activities may still result in an adjustment, right? So if there are other issues that IRS encounters with respect to the return, they're allowed to do that. Now, an original or amended return claiming a refund or credit based on an ERC is treated as filed on or before January 31, 2024, if the claim was postmarked. So you really have to look to see if was it postmarked and properly mailed or submitted to the appropriate IRS office by that date. Obviously, this is very technical, but it could save, or help your, the debtor, some of these, we've seen some of these ERC credits that are pretty large and greatly can impact a case. Now, if the disallowed ERC claim is just one among other items claimed on the return, the IRS can continue to process the other items as appropriate. So we just wanted you to be aware of the Employee Retention Credit and the One Big Beautiful Bill Act, and how it has impacted the ERC world. If we can go now to the next slide. So we're going to move away from ERC and talk about some of the other areas of the One Big Beautiful Bill Act, and how the One Big Beautiful Bill Act can help corporate bankruptcy or business entities, and how that tax can intersect and impact these types of entities. So the One Big Beautiful Bill Act permanently reinstated the 100% bonus depreciation. I'm not sure how many of you are familiar with that, but it was initially created by the Tax Cuts and Jobs Act for qualified property acquired and placed in service after January 19th, 2025 under the Internal Revenue Code section 168K. Now this here, I mean, it's 100% bonus depreciation, right? That is, initially you can depreciate 100%, which in the depreciation world, that's not a common thing. Transitional election permits taxpayers to apply 40% to 60% bonus depreciation on certain property placed in service after January 19th, 2025. So what is this bonus depreciation, right? It is a tax incentive that allows businesses, as I said, to immediately deduct the cost of qualifying assets, such as equipment, instead of over time, which is traditionally how depreciation is taken. This strategy can reduce a company's income tax, which in turn reduces its tax liability, right? And a lot of companies want the tax liability reduced so that they can pay less tax. Bonus depreciation can also is also known as additional first-year depreciation deduction, or the Section 168K allowance, which allows businesses to write off a large percentage of eligible assets costs in the first year it's placed in service. Any remaining costs then can be deducted over multiple years, just as traditional depreciation methods. Now, what does this mean in bankruptcy? In bankruptcy, this allows distressed companies to aggressively write off investments, but when combined with high interest rates, as Angela discussed, it may increase operating losses that need to be managed through Chapter 11 restructuring. What type of properties qualify for this bonus depreciation? Generally includes tangible property with a recovery period of 20 years or less, such as certain types of vehicles, computers, furniture, and machinery. It also includes qualified improvement property and certain new, used, or self-constructed production property. So that includes for the entertainment industry, and also rental and investment properties can qualify for this bonus depreciation. A lot of people ask, what is the difference between bonus depreciation and Section 179 depreciation? They're both immediate expense deductions. Bonus depreciation allows taxpayers to deduct a percentage of an asset's cost upfront, up to 100%, right? But in contrast, Section 179 allows taxpayers to deduct a set dollar amount. And these are the notable differences, but depending on the dollar amount or the percentage for the qualified property, it really might, be very impactful to get that 100% bonus depreciation through the One Big Beautiful Bill Act. Next slide, please. So there are some other corporate bankruptcy and tax intersections involving the One Big Beautiful Bill Act. The One Big Beautiful Bill Act permanently restores the, I didn't want to, so this is the earnings before interest, tax, depreciation, amortization standard for Section 163J business interest deductions starting in 2025. So basically what this means is that by adding back depreciation, amortization, and depletion to adjusted taxable income, or ATI, businesses can deduct more interest expenses compared to previous limitations, which can be very beneficial for highly leveraged companies navigating through the complex bankruptcies, right? So this is another positive for certain businesses. Another positive is the qualified business income deduction through the One Big Beautiful Bill Act. 20% qualified business income deductions under Section 199A was made permanent by the One Big Beautiful Bill Act, replacing its Schedule 2025. Basically, the One Big Beautiful Act replaced the qualified business income deduction from going out of existence. This provides permanent tax benefits for businesses like sole proprietorships, partnerships, and S corporations. So again, this is benefiting small businesses. It remains critical for small business owners, and especially because it reduces taxable income, which is a key factor in calculating disposable income for restructuring plans, tax liabilities, etc. If we can now go to the next slide. So we're going to change gears now and talk about something I think it's been in the news a lot, IRS reduction in force. As many of you have heard, IRS has undergone significant reduction with over 25,000 employees separating or taking buyouts since January 2025. So at the end of 2024, the workforce at the IRS was around 102,000. Now in early 2026, the numbers are close to 75,000, right? So that's a large number of employees that have left, separated from the IRS. So which offices, which areas of IRS has this impacted, which can obviously directly impact taxpayers? Well, 27% of tax examiners, so there's a reduction of 27%. Well, who are tax examiners? Well, they're the ones that review and process federal tax returns, right? They're a very important part of IRS, and so having a 27% reduction is a big deal. Revenue agents. 26 to 31% reduction of revenue agents. These are the auditors who examine individual and business tax returns. That's a big number, 31%, up to 31%. So that's impacting the workforce at IRS. Where else have this 25,000 number gone from? Well, business units like contact representatives, IT management, and clerks and assistants were also deeply affected. Now, how does that impact taxpayers, right? What officers and divisions? Well, direct file lost over 80% of the staff, according to reports from Transformation and Strategy Office experienced a 95% decrease, going from 80 employees to 4 employees. Information Technology and Operations saw a 51% reduction. The Chief Tax Compliance Office saw a 90% reduction. Large Business and International, they saw a 38% loss in staff in 2025. In the Large Business and International, that unit is responsible for the auditing the large corporations and high wealth taxpayers. Small business and self-employed also experienced significant cuts, and taxpayer service offices lost 20%. So this is a huge impact on IRS. And I believe, Angela, you're going to tell us a little bit about how this impacts taxpayers, right? Next slide, please.
Angela, it looks like you're muted.
Sorry about that. Yes, so from a practical perspective, if you are representing debtors, again, because of the reduction in employees at the IRS, we can assume that things are going to take longer to process, whether that's a refund, whether that's an amended return. And if you have a client who's filing for bankruptcy, that can impact in your plan. Or even if you're a consumer debtor in a Chapter 7 case, it can have an impact on that, in that you may have a refund that you're counting on that you want to get. So if knowing that there's going to be longer wait times and to process things, what can you do? Obviously, as I mentioned before, unless there's some other, factor that's causing the filing of the bankruptcy, such as, a foreclosure sale or a wage garnishment or levy or, something critical, to the extent that debtors counsel can advise their taxpayer, would-be debtor clients to get a handle on their taxes, get them prepared, at least if not filed before filing, that will help assess what is your tax liability. And as we just discussed with some of these newer deductions that are available to businesses and individuals alike, you may want to know before you file, what changes in your circumstances have been. Maybe you will learn that your debtor doesn't owe as much tax as they thought they owed, or maybe you will learn that they are actually going to get a refund, which can help in certain ways. So, and that will also affect the timing of a bankruptcy filing. So that's one thing to keep an eye out for. The digital tools that mentions on this slide, it says IRS online account to check status. That's, even though it's not always the most efficient, it's still better than, trying to get somebody on the phone. That can be very, really time consuming now with the, it was pretty difficult even before to get somebody on the phone without long wait times, but now the wait times are even longer. Electronic filing, to the extent people can do that, I think is still recommended. And as we were talking about earlier with processing the employee retention credits, people just need to expect that even if you are getting a refund, or you think you qualify for an employee retention credit, or maybe you need to amend your return to claim some kind of a credit or a refund, that's going to take, you just have to understand that that's going to take longer than it has. But Naja, I did want to ask you about this, working at the U.S. Attorney's Office still, representing the IRS along with some other government agencies that you're working on now, are you seeing more debtors in bankruptcy? And I just mean general, this is not an exact percentage or anything like that, but are you noticing that there's been more litigation or claim objections filed because of this, slowdown or lack of response through the regular channels?
Well, I didn't plan for you to ask the question, but you have set it up perfectly for us to go to the next slide. So here we go, and I'll answer the question if we can go to the next slide. So what is happening at IRS, right? What is happening in the bankruptcy tax world as a result of everything that's happening in the world today, including the reduction in force? Absolutely. My office, we are seeing more and more objections being filed to IRS proofs of claim. And one of the big objections that we're seeing is exactly that they can't get a hold of IRS. They don't know what's going on. So debtors are now filing objections just in order to, resolve their case, their claims. And what kind of cases are we seeing? These types of objections, they're mostly, hey, the debtor filed a return. Why is an IRS amending the claim? Or the debtor filed an amended return. Why is an IRS amending the claim? Well, as we talked about, it's taking IRS a lot longer to process the returns, to process the paper, whether it's electronically filed or paper filed. So debtors are now going to bankruptcy court and using the bankruptcy to get these matters resolved. And frankly, to answer Angela's question, when it comes to my office, we are reaching out to IRS, and these issues are getting resolved because it's expedited. But let me put it out there: please don't file the objection, and have my office be inundated with these types of objections just to get the IRS's attention, right? Try to call the insolvency specialist, email, reach out the 1-800 numbers. We're going to provide the resources. Actually, you should have received resource materials that have very useful numbers to reach the IRS. What are some other things that we're seeing other than objections to claim, Angela? Well, one of the things that we're also noticing, based on the financial circumstances today, debtors are using what they should be paying the IRS, the trust fund, payroll taxes. Instead of paying IRS payroll taxes or income taxes, they're using that to pay their other creditors, and they're becoming post-petition delinquent. Well, what does this mean, right? Well, in bankruptcy, that could be very consequential. IRS can file motions to convert the cases from 11 to 7, or have the cases dismissed. And we're seeing a lot more of these post-petition delinquency issues where the debtors are just not keeping current, which they're required to do under the law. And so a lot of our work now involves filing either these motions or agreements and stipulations to get these debtors become current. Because what a shame, after almost 3-4 years of paying into the plan or filing for these types of bankruptcies, to get the case converted or dismissed. Another area that we're seeing debtors come in is, we had the wildfires last year in Southern California. Pacific Palisades was one of the areas hard hit. And so the IRS did provide relief for those affected businesses and individuals. IRS gave them extension, not just for filing returns, which in the past they have provided that, but also for paying the taxes owed, individual returns, business returns. All of these extensions or postponements were through October 15th of last year. It is now April, what is today? April 7th. So it is no longer October 15th or earlier. So these tax relief postponements are over, but we are seeing debtors still arguing that they had, IRS had given them relief. They don't need to file the returns. They don't need to pay their taxes. But that's no longer in play. So, payroll, quarterly returns, the first quarter, second quarter for 2025, they are due. And if you haven't filed by October 15th for last year's first and second, quarter's payroll, IRS they're asserting penalties and hefty penalties, right? So file these delinquent returns, pay these taxes. Another thing that we're seeing that's coming to trend are these audit reconsiderations. And audit reconsiderations, something that, IRS can go back and look at a taxpayer's return to see if they can be provided deductions, for example, or give them credit so that the liabilities are smaller. We're running out of time, Angela, so I think we're going to go into the last area, which is the canceled debt. A large trend that we're seeing are these federal student loan cases. Some fun facts, or not so fun. The U.S. Department of Education has nearly $1.7 trillion in student loans. That's right. If you didn't think you heard right, $1.7 trillion. Nearly 43 million borrowers have outstanding federal student loans, and less than 40% are paying back the student loans. About 7.7 million recipients are in default. That's about 25% of the total amount of student loan recipients are in default, which equates to about 100 million in defaulted loans. If we can go now to the next slide very quickly so we can try to get some questions answered. Okay. Starting from March 26, 2026, so that's just a couple of weeks ago, the U.S. Department of Education and the U.S. Department of Treasury announced the Federal Student Assistance Partnership Program to enhance the administration of federal student loans and programs, right? So the Department of Education is transferring the management of roughly $180 billion in defaulted federal student loans to the Treasury Department. What does this mean for borrowers? So the defaulted loans will be shifting to be handled by the Treasury. The focus, of course, will be on rehabilitation, but the Treasury and IRS are very, very good at collection activities, right? A lot of experience collecting debt from taxpayers. Now, the Treasury is going to move to student loan borrowers. Now, there's a limited immediate impact on non-defaulted student loans. So this is for defaulted student loans. We're talking about the, what are we talking about? The 43, the 7.7 million recipients. So this is part of a bigger, broader restructuring. Now, let's go to the next slide because I think we have like 4 minutes. In the bankruptcy world, however, in order to get your student loan discharged, you have to file an adversary action. There were student loan collections paused between March 2020 and September 2023, but collection has resumed. And, many of these borrowers, as we described, are finding themselves in default. And many student loan borrowers are filing for bankruptcy to get their student loans discharged. But just filing for bankruptcy is not sufficient. You have to file an adversary action. And starting in November 2022, the Department of Justice issued guidance joined with the Department of Education, streamlining the litigation process to get these student loans discharged through, the hardship discharge. So there's a 3-part test: present inability to pay, future persistence of financial hardship, and good faith efforts. The success rates have been phenomenal. It's jumped to 87% of student loans that are getting discharged from the 61% in 2017. We have some facts here that we included. Just, women make up 73% of the student loan bankruptcy filings. Did you know that? I did not know that. Student loan balances range from, the average is about 115,000. 10% of the borrowers owe more than 240,000. That's a huge amount. What age group are we talking about? Student loan borrowers, wide age group, 24 to 76,000. Here's an interesting fact. Between 2011 and 2024, more than 3 million student loan borrowers filed for bankruptcy. Huge group, right? But only 7,293 of those filed for adversary actions to get their student loans discharged. Since the guidance have been issued, there are more and more people filing for these student loan dischargeability, but yet the numbers, just don't compare. In 2025, about 1,700 student loan debtors filed for these adversary actions, but the success rates are like 87%. So really, we really should be, filing these student loans adversary actions. Next slide, please. Angela, do you want to just briefly go over that and then we can get to the end?
Yes. So this slide, what do we have? This is kind of just a recap on the loan. Okay, so this actually discusses loan forgiveness in a non-bankruptcy context versus loan forgiveness in the bankruptcy context, which is called a discharge. So Naja just discussed that. You need to file an adversary proceeding, but there are these other plans that the government is offering, in my understanding, and maybe things will get clarified, now that Department of Treasury is going to be servicing these loans. I haven't heard anything about these programs going away. They are still, as far as I know, being processed, but I guess it will just be processed in Department of Treasury instead of Department of Education. But there's the American Rescue Plan Act. That one, I guess, has expired. But the Public Service Loan Forgiveness Program, also, from what I understand, is still, they're still processing those applications. And under that program, if you are eligible for partial or full loan forgiveness, it is not considered a taxable event. Whether or not you do that through a bankruptcy case, that cancellation of debt is not considered income under the Public Service Loan Forgiveness Program. But some of these other partial discharges under other programs, or even with the income-based repayment plans, which I don't think have actually, the ones that have 20 and 25-year long repayment plans, I don't know if it's even been tested yet, but it's unclear if that cancellation of debt would be taxable income or not. So these resources that we mentioned here, IRS publications, well, these actually, I apologize, those are not specific to student loans, but the point of the slide is to keep in mind that if you are getting tax debt or student loan debt canceled outside of bankruptcy through some of these other programs, to keep in mind that it may be a taxable event. Cancellation of debt may be considered income. So, something to keep in mind. And I think that we're actually just about out of time. I don't know if we have any questions to answer that we could take up in the next couple of minutes.
Doesn't look like there actually appears to be any questions at this time.
Great.
Okay, well then that's great. We finished right on time. And so the final thoughts on this slide is just we wanted to discuss the trends that we're seeing in bankruptcy, which is generally increasing level of filings by both consumers and businesses alike, including big corporate bankruptcies. Just in 2026, we just saw another big corporate retail, Saks Fifth Avenue, just filed in 2026. So the trend, we believe, is going to continue. For how long, we don't know. But if you're in the tax world or the bankruptcy world, these are all things to keep in mind as they are influencing filings. So.
And final slide, please. Okay, the last slide, sorry. We wanted to provide you our contact information and want to say thank you very much for spending 1 hour of your precious time with us. We also provided materials, resources to help you how to contact the IRS, where to contact the IRS, as well as frequently asked questions involving IRS and bankruptcy, as well as the Supreme Court case that Angela spoke on regarding tariffs. Thank you so much. And Angela, any last words?
No, hope to see you soon.
Yes, hope to see you soon. Thank you.